Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sunoco Lp annual report. Sunoco Lp offers a diverse range of businesses and services that cater to various aspects of the energy infrastructure industry. The company's primary focus is on distributing motor fuels and other petroleum products across the United States through its fuel distribution segment. This segment not only distributes motor fuels, but also provides additional services such as credit card processing, car washes, lottery, and in-store merchandise sales. Furthermore, Sunoco Lp operates retail locations where customers can purchase food services and non-fuel products. In addition to fuel distribution, the company's pipeline systems segment includes an integrated pipeline and terminal network that transports refined product, crude oil, and ammonia pipelines and terminals. The terminals segment operates transmix processing facilities and refined product terminals, offering blending, additive injections, handling, and filtering services. Overall, Sunoco Lp provides a comprehensive range of businesses and services in the energy infrastructure industry, including fuel distribution, pipeline systems, terminal operations, and retail services. The recent surge in Sunoco Lp stock price can be attributed to several key factors. One major contributor was the company's strong fourth quarter and full-year earnings for 2025. Despite missing analyst expectations on reported earnings per share (EPS), normalized EPS far exceeded forecasts, and revenue surpassed projections. This positive news led to a significant surge in the stock price. Another factor contributing to the increase is Sunoco's strategic acquisitions and growth outlook. The successful acquisition of Parkland Corporation has expanded the company's midstream and retail footprint, with analysts viewing it favorably. Management has also set a positive 2026 adjusted EBITDA target of $3.1 billion, $3.3 billion, signaling expectations for multi-year profit improvement. Additionally, Sunoco Lp's consistent distribution increases have enhanced its appeal to income-focused investors. The company has consistently increased its quarterly distributions, with the most recent increase announced on January 27, 2026. This trend of increasing dividend payments and growth targets has contributed to the stock's upward trajectory in the past year. Sunoco Lp maintains a market capitalization of $12 billion, broadly in line with the industry peer group. Sunoco Lp trades at a higher price-to-earnings ratio of 22 times and a lower price-to-book ratio of 1.32 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 72% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 5.85%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for Sunoco Corp can be attributed to several key factors. Acquisitions have played a significant role in driving revenue growth, with notable acquisitions including Parkland acquisition in 2025 and Tanquid acquisition in 2026. Additionally, the fuel distribution segment has experienced a 15% increase in gallons sold, resulting in an increase in profit per gallon sold. The pipeline systems segment has also contributed to revenue growth, with an increase in pipelines throughput of 289,000 barrels per day. Furthermore, the segment adjusted EBITDA for the fuel distribution and pipeline systems segments have shown significant improvement, indicating a positive trend in revenue growth. In contrast, there are no reported drivers of revenue decline. The company's geographic breakdown reveals that the majority of its revenue comes from the United States, with Canada and foreign markets contributing smaller shares. However, it is worth noting that the company has experienced fluctuations in revenue from these regions over the past few years. The net income of the company experienced a significant decline between 2024 and 2025, decreasing by $347 million. This decrease was largely due to various factors, such as a $150 million increase in interest expense, a $29 million increase in losses on extinguishments of debt, and the absence of a $586 million gain on West Texas sale that occurred in 2024. However, despite this decline in net income, the company's profit margins also decreased. This was primarily due to inventory valuation adjustments, which increased from $86 million in 2024 to $156 million in 2025, as well as impairment losses and changes in estimates of future cash flows and EBITDA. Despite these decreases, there were some notable changes that suggest a more positive trend for the company. The adjusted EBITDA increased by $590 million year-over-year, from $1,457 million to $2,047 million. Additionally, net cash provided by operations increased by $641 million, implying an increase in profit margins. The reasons behind these changes are multifaceted and include uncertainty around climate change regulations, volatility of motor fuel margins, rising interest rates, slowing economic growth, tariffs, inflationary pressures, and potential interest rate increases. Furthermore, the decrease in demand for motor fuel and refined petroleum products also contributed to the decline in profit margins. Overall, while the company's net income decreased, its adjusted EBITDA increased significantly, suggesting a more resilient financial performance. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The data shows that the net cash provided by operating activities has increased substantially over the past year, rising from $549 million in 2024 to $1,192 million in 2025. This increase suggests that the company is becoming more efficient in managing its day-to-day operations and generating revenue. The positive trend in operating cash flow is a significant indicator of the company's financial health. It implies that the company has sufficient liquidity to meet its short-term obligations and invest in growth opportunities. Furthermore, this improvement in operating cash flow suggests that the company's management team is effectively implementing strategies to optimize profitability and reduce costs. Overall, the data indicates that the company is generating positive operating cash flow, which is a key indicator of financial stability and success. The company's debt level has undergone significant changes over the past period. According to page 64, total debt increased from $7,486 to $13,389, while long-term debt rose from $7,484 to $13,372. This substantial increase in debt is a notable trend. However, there are also instances where interest expenses have changed significantly. On page 57, it was reported that interest expense surged by 150%, $391 million to $541 million, and loss on extinguishment of debt increased by 1,450%. Furthermore, on page 65, the issuance of senior notes led to a total debt increase of $2 billion, but interest expenses decreased due to lower interest rates on new debt. In contrast, there are instances where changes in debt level or interest expenses were not significant. For example, on pages 57 and 58, it was mentioned that interest expense increased significantly due to an increase in average total long-term debt, but the actual numbers were not provided. The company's performance across various segments and regions has been mixed. On a positive note, ETS Permian, JC Nolan, SARA, Fuel Distribution, and Pipeline Systems have shown significant improvements in their financials. ETS Permian saw an 83% increase in equity and earnings, while SARA experienced a 100% increase in equity and earnings and a staggering 700% rise in adjusted EBITDA. Fuel Distribution reported a revenue increase of $0.154 billion, with segment-adjusted EBITDA reaching $990 million. Pipeline Systems also saw a significant revenue boost of $1.703 billion, with segment-adjusted EBITDA increasing to $718 million. On the other hand, some segments and regions have underperformed. The other segment witnessed a 100% decrease in equity and earnings, indicating a substantial decline in financial performance. Refinery operations were particularly disappointing, as revenue and segment-adjusted EBITDA remained at zero for both 2023 and 2024. Canada also experienced a decline in revenue by $44 million compared to the previous year. Management's primary focus is on long-term performance, with an emphasis on strategic growth and expansion. To achieve this goal, they plan to integrate recent acquisitions successfully, manage growth while controlling costs, and identify new opportunities for accretive acquisitions. The company aims to diversify its business through these transactions, adding scale and expanding cash for reinvestment and distribution growth. Management also expects to generate ongoing sources of liquidity from operations, borrowings, and debt issuance or partnership unit sales. This will enable the company to pay quarterly cash distributions to common unit and Class C unit holders. Furthermore, executive compensation is heavily incentive-based, with a significant portion tied to long-term performance metrics. This approach aims to retain key drivers of future success through equity awards and incentives, ensuring that top talent remains committed to the company's growth strategy. The company has made several significant acquisitions in recent years. One notable acquisition was the Parkland acquisition, which took place on October 31, 2025, for $2.6 billion. This acquisition included the refinery business of Parkland, a Canadian corporation indirectly acquired through Sunoco Retail. Additionally, the company acquired Tanquid on January 16, 2026, for €465 million, $540 million. The company has also made several smaller acquisitions, including fuel equipment, motor fuel inventory, and supply agreements in Cone 2025 for $17 million. 151 fuel distribution consignment sites in Kutwo 2025 for $105 million. 70 fuel distribution consignment sites and 100 supply agreements in Q3 2025 for $85 million, and 27 fuel distribution consignment sites, 36 dealer sites, and commercial customers in Q4 2025 for $64 million. Furthermore, the company acquired the Burnaby refinery located in BC and contributed all of its Permian crude, oil, gathering assets and operations to ETS Permian. These acquisitions demonstrate the company's efforts to expand its operations and increase its market share. In contrast, there are no explicit mentions of divestitures made by the company. However, it is noted that divestitures could potentially impact cash flows from operating activities. There are several concerns about inventory buildup or supply chain disruption that have been identified. One major concern is the impact of extreme weather events on suppliers and customers' facilities, as well as on distribution networks. This could lead to a decrease in demand for motor fuel, reducing Sunoco's ability to make distributions to unit holders and impacting profit margins. Additionally, there are concerns about supply chain disruptions caused by tariffs imposed by the U.S. government, ongoing changes in trade policies, and potential terrorist attacks or threats. These factors could lead to uncertainty and volatility in financial markets, affecting the supply chain and potentially causing inventory buildup. The dependence on third-party pipelines and facilities is also a concern, as their unavailability could impact Sunoco's operations. Furthermore, climate change may lead to increased frequency and intensity of extreme weather events, potentially causing more pronounced weather-related risks. Overall, these concerns highlight the potential risks and uncertainties that Sunoco faces in terms of inventory buildup and supply chain disruption. While some of these concerns are mentioned in the context of potential risks rather than current issues, they still warrant attention and consideration by management to mitigate their impact on the company's operations. That concludes the financial summary for Sunoco LP. Feel free to comment below, and I will be happy to answer them when possible.